Welcome to the Ether Vector. I'm Lewis Maverick Adams. Today we decode one of the most important structural transitions happening inside modern finance, the rise of the quant human. This is not a role, this is not a buzzword. This is a structural response to a structural problem, a system that evolved faster than the institutions governing it. This story really begins with a simple question. Why did two major institutions collapse even though the math was correct? Silicon Valley Bank did not fail because it miscalculated duration. First Republic did not fail because it mispriced risk. They failed because the system surrounding the math was incoherent. Risk lived in one silo, liquidity in another, customer behavior in another, supervisory expectations in yet another. When the system is fragmented, no single leader can see the entire propagation chain. Most institutions were architected for a world that no longer exists, a world of monthly committees, quarterly reviews, and static governance. But today's systems do not operate in months or quarters. They operate continuously, autonomously, and interdependently. AI driven models update in real time. Customer telemetry reacts faster than humans can think. Liquidity behavior shifts before committees even meet. Human governance still assumes discrete steps. The machinery of finance no longer works that way. This is where I think people misunderstand the entire idea. Generalist spans domains. Quant human integrates domains. A generalist knows a little about a lot. A quant human sees the system as one coherent organism. Mathematical behavior, economic behavior, regulatory triggers, and even system propagation all tied together. So, fragility doesn't begin with catastrophic failure. It begins with something small, something that no dashboard catches, right? A proxy variable shifts, a fraud agent penalizes the wrong behavior, a routing engine takes a shortcut, a marketing classifier overweights a demographic signal. Each of these looks harmless in isolation, but with an interconnected system, they propagate. And so here we have a propagation containment model, and it basically shows a before and after picture. And what it is in trying to show is that exactly what it says: a small shift has cross domain consequences. So something that begins as a shift in marketing will have domain consequences or cross domain consequences downstream within servicing. And so on the surface, we may not notice it looks harmless in isolation, but ultimately it has downstream consequences to fraud, underwriting, pricing, servicing. And so where there is a lack of governance, if you will, through a role such as a quant human type role with a full picture oversight, there is downstream consequences, there is real fragility, and there is real cross domain consequences. Looking again at the propagation containment model, so one upstream decision echoes across the entire institution. A model becomes an economic distortion. That distortion becomes a fairness concern. That fairness concern becomes a capital signal. That capital signal becomes a liquidity behavior. That liquidity behavior becomes a supervisory moment. And this is the nature of the AI era, right? And so uh, it's the link between models. This is what it is, the link between models. And it's the entire prudential architecture. So once again, one decision echoes across the entire institution. And so I think that's something that for those of us who work in this industry and are passionate about this industry, we need to really keep that in mind. It's the nature of the AI era specifically, but it's also the nature of this industry. So something that occurs in marketing, especially with autonomous workflows, um, has impact across the institution, and it's not something necessarily that a dashboard's going to pick up. And that's where we argue in a recent white paper that someone with enough knowledge, we use the term quant human, that someone with enough knowledge, uh, that organizations and institutions need to have folks with, again, we call them quant humans, with the type of knowledge that understand enough about transactions, enough about economics, enough about systems and risk areas to be able to look upstream and downstream to know that there is potential, or that when there are shifts in terms of changes to systems or transactions, what the actual impact is going to be. And that isn't to replace specialists, and it isn't to become generalists. It's that there are folks with the right type of knowledge in specific areas to be able to challenge things and to know upfront that something's going to occur. Again, because one decision has echoes across the entire institution. And so, once again, it's something that we've argued in our recent white paper, again, that we call Quant Humans. And so, I encourage you to, again, read the white paper, think about that in your day-to-day efforts, work efforts inside of institutions as changes are made, especially with AI, generative AI, but more specifically with autonomous workflows. Okay, so we talked about in the last slide the quant human. Uh, we talked about the fact that we wrote about this, the Aether vector, in our latest white paper, in our thought leadership white paper. Here on the screen, we are showing you the competency map that we argue should make up uh, the quant human, and it's in 4 layers. Okay, and we'll talk about each layer independently, but the 4 layers are mathematical and algorithmic. No surprise there, right? In the AI era, financial services, banking, um, economic and financial, risk and regulatory, systems and architecture. So again, these are the 4 layers. This is the competency map that we argue should make up what the areas of knowledge, if you will, of the quant humans, the individuals that the organizations uh, will likely need over the next decade as AI models, AI architecture, generative AI, autonomous workflows come online over the next decade and become more of a factor in day-to-day business. So, would love to hear your thoughts, your feedback. Would love for you to read the white paper, which again we have published as serious uh, thought leadership, and as a policy document for those in leadership roles and those who decide policy in government roles. But again, would love to hear your feedback. So we're looking again at the 4 layers of the quant human. And we know, based on the research we've accomplished in our white paper, the information we've gathered, really there is only one archetype that has the overall capability of operating across all four domains that drive modern financial risk. And those four domains, the mathematics, the economics, the regulatory, and the systems, that is the Quant Human. And it's this cognitive design, this competency map. And so, uh, it's this architecture that is the foundation of the Quant Human that we're looking at. So these four layers constitute the structural competency map, the cognitive design, the architectural foundation of the Quant Human. And so, if at this point we hone in on layer number one, the mathematical and algorithmic reasoning, it's the system's first language. And layer one is the mathematical lens. And if you want to understand why institutions drift, you have to start with the math. Because math is where the system behavior begins. A quant human can see feature lineage, they can see drift signature, proxy variable risk, model monotonicity, data behavior correlation, fragility and decision boundaries. Do you know when they can see these things? Not at the end, not during audits, not at the time of audit, I should say, but they can see them in real time. Let me give you a cinematic example here. A fraud team adjusts a single proxy variable to reduce false positives. Perfectly legitimate move, very well intentioned from a business perspective. But the new variable behaves differently for different demographic clusters. It behaves differently for different demographic clusters. And so when you first hear that it behaves differently for different demographic clusters, that's probably going to present the first problem. On paper, it improves fraud precision. Inside the system, though, it presents a distribution shift, or it triggers a distribution shift that the underwriting team never sees. Second problem, because underwriting doesn't know that fraud has made a change in the system, so they never see this challenge coming towards them. They don't know that fraud has changed the upstream signals. So what occurs next? Well, in the system, approvals begin to rise, approvals begin to fall for those segment of customers. They begin to fall for those with high loan to value, low loss customers. So again, approvals fall for high loan to value, low loss customers for that segment of customers. For a second segment of customers, approvals rise for low loan to value, high loss customers. Expected loss curves bend, unit economics distort, capital forecasts tighten, and supervisory attention increases. And all of this starts with a single mathematical distortion entered by the fraud team, or triggered, I should say, by the fraud team. All of this starts with a single mathematical distortion triggered by the fraud team. that the institution currently is not cognitively configured or structured to see, or note, or notice. A quant human, however, sees this shift immediately because layer 1, the mathematical layer, is their native language. Let's look at layer number 2, economic and financial reasoning. The engine beneath the system, or the wind beneath my wings, so to speak. Here's the part that people underestimate. Models don't make predictions. Models make economics. Again, models don't make predictions. Models make economics. Please remember that. Every threshold, every regression boundary, every incentive band, every eligibility rule reshapes capital, liquidity, profitability, and risk-weighted assets. Let me say that again. Every threshold, every regression boundary, every incentive band, every eligibility rule reshapes capital, liquidity, profitability, and risk-weighted assets. A quant human thinks in terms of economic propagation and not just model accuracy. Again, not just model accuracy. Let me give you a cinematic version of that example or that explanation. A product team adjusts an economic, rephrase that, a product team adjusts an underwriting threshold to increase approvals. The uplift certainly looks good. Acquisition jumps, and I can tell you from time I've spent in marketing, it's all, or consumer marketing at least from a consumer finance perspective and brand and co-brand, it's all about the acquisitions, although it's also about existing customer marketing, or what we call ECM. Anyway, the uplift looks good, acquisitions jump, conversion rises, marketing celebrates. But behind the scenes, things are beginning to take shape, or things are beginning to be noticed. Loss rates increase at a disproportionate rate. So that probably what occurs is that the decision management folks and the risk management folks have started to take a closer look at things. Expected loss curves steepen. Capital consumption rises. Risk-weighted asset volatility increases. Liquid buffers narrow. Approval patterns appear unnatural to regulators. So something, again, they start to see anomalies. The model didn't just change performance, it changed the institution's balance sheet. It changed the institution's balance sheet. Most teams never see this until it's too late. They never see this until it's too late. However, the quant human sees it instantly, because layer 2 indeed is the map of their engine. Okay, let's take a look at layer number 3, risk and regulatory reasoning. We sometimes refer to it as risk and regulatory intelligence. It's the institution's operating license. Every model is ultimately a regulatory argument. A regulatory argument. Not explicitly, However, in function, it is a regulatory argument. When regulators arrive, they do not audit code, they audit consequences, they audit outcomes. They ask questions such as, what population is affected? What is the distributional impact? What is the capital effect? Where is the supervisory trigger? How does this model behave under stress? How does it interact with other models? Most institutions can answer two of these. They cannot answer all six coherently. A quant human can. Let me give you a cinematic example of this line of questioning, or a cinematic example of a circumstance. In this example that I'll walk you through, the fairness anomaly is what becomes a supervisory trigger, or maybe what you might just simply say a red flag. Marketing, in this example, optimizes a personalization algorithm. It slightly increases in a young, it slightly increases acquisitions in a young, high growth segment. Good on paper so far. However, in the process, it subtly reduces exposure to an economically disadvantaged segment. That was not intentional. It was not malicious. However, mathematically, the outcome was that it reduced exposure to an economically disadvantaged segment. And as you know, doesn't matter whether it was intentional, and it doesn't really matter whether it was malicious. Well, maybe in the end, maybe at some point it does matter. What really matters is the mathematical impact, because once the math is introduced, the math becomes the outcome, really. And thus, over 3 weeks, the impact begins to show up. The approval distribution shifts. The adverse impact ratio decreases. The complaints rise. A demographic skew emerges. A regulator's monitoring system flags the pattern. The supervisory team asks what is considered a fatal question. Explain exactly how this model creates distributional impact. And of course, most institutions scramble for months. A quant human answers in minutes, because layer 3 is their regulatory reasoning engine. Let me repeat that again. Layer 3 is their regulatory reasoning engine. So we're going to cover layer number 4, the systems and architecture layer, also known as the propagation layer. Arguably the most important layer of the 4. This is where everything comes together, because institutions do not fail into a single model. They fail in the distance between models. They fail in the propagation. A quant human maps API dependencies, real-time routing behavior, drift propagation paths, multi-agent interaction, upstream and downstream coupling, cross-domain exposure, failure modes across the entire decision spine, and other activities. Let me provide you with an example, a cinematic moment, which is a phrase I've been using throughout this presentation. In this example, a real-time routing change becomes an operational risk event. The engineering function adjusts a real-time routing rule to balance system load. Again, perfectly reasonable, perfectly rational. However, that routing rule change has the effect of altering the distribution of applications. The fraud pattern, the approval cadence, the settlement timing, and ultimately the liquidity profile that is seen by the treasury function. One routing change, dozens of downstream impacts. Nobody notices because no team owns the entire chain, except a quant human who sees the architecture as a single living organism. A single living organism. We've talked about the 4 layers of the quant human. We've looked at each of the layers independently, the importance of the layers independently, the structural makeup of the layers, of the individual layers. And I want again to summarize the importance of the layers as a whole, and why the layers matter. Uh, each layer, of course, is powerful on its own. But the structural advantage comes from the consolidation of these 4 layers, or the integration of these 4 layers. Mathematics without economics, distortion. Economics without regulation, blind spots. Regulation without systems logic, misalignment. Systems without math, fragility. Only a quant human operates across all 4 simultaneously. And that is the cognitive architecture modern financial institutions were missing when Silicon Valley Bank and First Republic failed. And this is the archetype designed for real-time, multi-agent, model-driven finance in today's economy. Now that we've seen the 4 layers of the Quant Human's architecture, it's time to shift from theory to evidence. We are going to step inside the system itself to see the hidden mechanics that supervisors, executives, and even engineers rarely observe, to see what that connected spine actually looks like, to see the power of that vision in practice. And the first step is the most fundamental, the ability to trace a feature from the moment it enters the institution to the moment it shapes a decision, where that decision may impact the entire institution. So let's pull back the curtain. A single feature can move from marketing to underwriting to fraud to servicing. This is the foundation of explainability, fairness defense, and governance. Feature lineage gives us visibility, but visibility is only the first layer of coherence because in modern finance, every upstream decision, every score, every threshold, and every signal, flows directly into the economic engine of the institution. Said differently, this isn't just about governance. This feature lineage is a path to the ledger. Let me put this very bluntly. If you don't trace the data, then you can't trace the dollar. And the consequence of this misalignment is capital risk. So now we shift from lineage to the economics of consequence. This is the economic heart of the system. Attribution connects to lifetime value connects to expected loss, which connects to capital formation connects to long-run portfolio strategy. This is where most institutions lose coherence, and that loss of coherence doesn't happen once a quarter, it happens every millisecond. When you see the economics laid out clearly, you begin to understand why small upstream changes can quietly reshape capital, liquidity, and long-term portfolio behavior. But economics alone does not describe the full institution, because today the institution is a live system, a real-time organism. The institution is not a series of spreadsheets. It is a real-time decision engine. This is what that decision engine looks like. This diagram captures the truth of modern finance. The institution is a real-time system routing decisions, fraud agents, underwriting engines, CRM signals, behavioral telemetry, all operating as one chain. This is the architectural reality regulators are beginning to expect. When you view the enterprise as a real-time decision spine, you can finally understand how every part of the organization is connected. However, real-time architecture introduces a new source of fragility: autonomous agents. Agents that make decisions, respond to signals, and react to one another. The moment you build a system this complex, you unlock a terrifying potential: the potential for unmanaged drift. The parts can work perfectly, yet the whole fails silently. This is the danger of multi-agent misalignment. So now we shift from architecture to interaction. When autonomous agents interact without integrated governance, they drift. Fraud agents penalize the wrong patterns, underwriting compensates incorrectly, routing engines optimize for speed instead of safety. This is where multi agent misalignment produces silent fragility. This is where the future is already happening. When agents operate without integrated governance, you don't get error, you get drift. And drift in a multi agent environment, it doesn't stay local, it propagates. Silent fragility is unacceptable. We need an operational strategy that is not just about detection, it's about prevention. It's about drawing the lines. It's about containment. And this is the ultimate prudential firewall. So now we step into the supervisory heart of the problem: containment. This is the prudential value proposition: containment. stopping distortions at the source, preventing propagation across systems, reducing institutional fragility, increasing supervisory defensibility. This final diagram completes the system view. If you can contain propagation, you reduce fragility. If you cannot, you accumulate systemic risk. This isn't theory. This isn't a forecast. The systemic fragility we've diagrammed today has already produced material losses. I want to show you exactly how these failures manifest in the real world. Now that you've seen the architecture, we can finally turn to the evidence. 5 failures, 5 institutions, 5 lessons. Let's walk into the cases. These 5 cases are not hypotheticals. They happen inside real institutions, and each one reveals a different dimension of systemic fragility. Before we dive into each case individually, let me give you the map. These 5 failures are structurally different, but intellectually unified. They show us not how models fail, but how systems fail. A capital signal failure, a payments routing cascade, a multi-agent misalignment, a regulatory documentation failure, a marketing ecosystem transformation. Across these cases, you will see one theme. Institutions do not break at the model layer. They break at the systems layer. A capital signal, no one interpreted correctly. A drift in digital approval rates, initially perceived as isolated or benign by marketing, underwriting, risk, and finance, was a critical collective blind spot resulting from a systems coherence failure. This subtle change was actually triggered by a single segmentation feature in a conversion model overweighting a a volatile demographic propagating unexpectedly through the entire financial ecosystem, from the probability of default volatility to expected loss, and ultimately impacting capital allocation and risk-weighted asset sensitivity. The failure wasn't in individual mathematical accuracy, but in the organization's inability to synthesize the full propagation chain from a model's input change through to its supervisory and economic impact. This necessitates a quant human role that is focused on tracing the interconnectedness of models, economics, and capital to ensure systemic responsibility and control. Said differently, if no one is responsible for connecting the model to the economics, to the capital, to the supervisory chain, then nobody is responsible for the system. If you don't trace the data's silent march, then you cannot trace the dollar's final arc. A seemingly simple real-time routing update on a payments platform intended to optimize pricing by routing transactions to the lowest cost rail quietly became a profound operational risk escalation due to a model error misclassifying saved transactions. This mathematically generated risk led to downgraded transactions experiencing higher settlement delays, which then propagated into the balance sheet as liquidity timing mismatches, and subsequent reconciliation irregularities, ultimately drawing immediate supervisory attention. The critical failure was the 3-month delay in connecting the front end routing model change to its downstream liquidity side effects, underscoring the necessity of cross domain reasoning to proactively identify system wide risk propagation. So, I think the question here is, what is our design lesson from this payment routing cascade? Operational risk is now mathematically generated, and if you do not have cross domain reasoning, you do not see the system until after the damage is done. Said differently, when the model optimizes for speed and cost alone, the hidden risk arrives demanding its own loan. The fraud underwriting conflict. So, this is a case where the simultaneous deployment of independently validated agentic systems, specifically a tighter fraud anomaly detection agent and a looser underwriting credit limit model, created an insidious multi-agent failure because neither team was aware of the other's policy surface shift. So there's the communication factors, number one. This lack of institutional level synthesis resulted in a destructive chain reaction, an immediate surge in false approvals, followed by unexpected defaults, and ultimately a spike in fairness complaints due to disproportionate approval volatility across demographic segments, probably something we should have otherwise been expected. The root cause was the failure to supervise these interacting agents as a cohesive system, demonstrating that cross-domain model reasoning is non-negotiable for managing the collective unpredictable behavior of automated decision engines. So, what's our design lesson from this fraud underwriting conflict? It is agentic systems cannot be supervised in silos. They must be supervised as systems. Or, said differently, when the agents work in darkened, separate rooms, the cost of chaos blooms beneath their looms, of course. The documentation and interpretability breakdown. A new technically proficient machine learning based credit expansion initiative faced an immediate supervisory friction, not because of the model's performance, but due to a fundamental failure in governance and risk control exposed by the opaque documentation. Specifically, the model lacked a complete model card, clear feature lineage, consistent explainability, and traceable decision pathways, which regulators correctly identified as an unacceptable source of systemic risk. The ultimate institutional failure was the absence of a single individual possessing the cross-domain expertise to coherently link the model's complex math to its economic implications and the stringent regulatory and systems constraints. So, what's our design lesson from this? So, our design lesson is that in the AI era, Documentation is not administrative, documentation is governance and risk control. And only a cross domain mind can produce it coherently. The Quant Human. The algorithm may learn and soar in flight, but without the record, shadows obscure the light. The marketing ecosystem transformation. So, in this case, a high performing mid sized lender discovered that its seemingly robust acquisition and funnel metrics were deceiving. Its core marketing models were optimizing solely for conversion and not for critical factors like lifetime value, expected loss, capital alignment, or distributional fairness. This upstream misalignment created a systemic failure, leading to unexpected portfolio fragility, including fairness drift, disproportionate capital consumption, and inevitably supervisory scrutiny, with each downstream team, underwriting, finance, compliance, remaining siloed and unaware of the initial model's distorting logic. The necessary resolution involved a comprehensive intervention to unify the entire decision chain, encompassing the mathematics, economics, risk oversight, and systems architecture into a single governed spine to restore institutional coherence and reduce systemic fragility. So, what's our design lesson from this case? When you unify the mathematics, the economics, the oversight, and the architecture, you unify the institution, you restore coherence, you reduce fragility, and you regain the supervisory confidence. If the models chase short term segmented gain, the whole portfolio must endure the rain. Talent evolves, governance evolves, prudential expectations evolve. The quant human becomes the cognitive infrastructure for navigating it all. What these implications reveal is simple but profound. We are entering a decade where the institutions that survive will be those that rethink talent, rethink governance, and rethink the supervision of agentic systems. So let's talk about what the future enterprise truly looks like. What the next decade demands. Agentic AI will require integrated supervision. Real time governance will replace static controls. Cross domain operating models will become the baseline, and the quant human will sit at the center of institutional stability. And that brings us to the final point. The future of finance is already here. And in that future, the single greatest competitive differentiator is no longer speed, it is coherence. Coherence is stability, coherence is value. The future will not reward institutions for accelerating blindly. It will reward institutions that can maintain coherence in a real time, multi agent, AI driven world, and that is where we close. The differentiator of the next decade will not be speed, it will be coherence. For a deeper dive with more case studies and technical analysis, listen to the full podcast on Spotify, Apple, YouTube, Amazon, Apple, and others. You may also visit lewisvadams.com or ethervector.com. I'm Lewis Maverick Adams. This is the Ether Vector. See you in the next episode. If you are interested, stand by for a deeper dive extended analysis as part of this webcast. We used to fear models that break. And today we must fear the models that work too well but fail to agree. Before we close, I want to take you into the deeper layer of this conversation, the layer reserved for regulators, systemic risk researchers, and those building the next decade of financial architecture. This is the part that typically never makes it into public discussions. It's where AI, economics, governance, and system design converge into a single institutional reality. If the main webcast explained the what, this extended analysis explained the why it matters at a structural level. So next, I'll speak on agentic systems and multi-agent governance when models become actors. Agentic systems are not just models that generate outputs, they are systems that initiate actions. A fraud agent adjusts thresholds, a routing engine reorders payment paths, a credit decisioning agent reevaluates approvals in real time. Individually, each of these autonomous workflows is manageable. But what happens when they optimize simultaneously, each one pursuing its own objective function with no central governance spine? You receive cross agent feedback loops. One agent tightens thresholds, causing another agent to compensate. That compensation changes upstream eligibility, muting a third agent's signals. This multi agent drift creates a governance environment where no single dashboard reflects the true state of the system. Regulators are beginning to recognize this. Supervisory frameworks across the EU, the Monetary Authority of Singapore, and the Bank of International Settlements are converging around one idea. Systems must be governed not model by model, but as interdependent ecosystems whose behavior emerges from agent interactions. The models are perfect. The ecology of their interaction is where the system fails. Model to model propagation, when one change reshapes the entire institution. In modern finance, a model rarely operates in isolation. A fraud model feeds an underwriting model. A underwriting decisions shift portfolio composition. Portfolio shifts alter expected losses modify capital forecast. Propagation. In older eras, propagation was slow, quarterly reporting, monthly committees. Today, it is instantaneous. Consider a micro example. A fraud model slightly adjusts its sensitivity to behavioral anomalies. Approvals drop, risk scores shift, marketing's targeting logic adapts. A different demographic distribution enters the top of the funnel. Fairness patterns change. Expected losses move, capital consumption rises, supervisory metrics tighten. No single model was broken. The system propagated a small distortion into a material prudential signal. This is exactly the scenario regulators now fear: silent propagation, not active failure. In the age of AI, a small upstream is a structural threat downstream. Prudential stability under AI era conditions. The new liquidity problem. When AI systems alter customer behavior, those behavioral shifts create second order liquidity effects. A change in routing logic influences settlement timing. A change in fraud thresholds affects the inflow of approved customers. A change in underwriting quality affects early cycle losses. A change in credit limits influences payment behavior and cash flow velocity. Liquidity risk was once primarily macro. Today, it is micro propagated from model behavior. The Bank of International Settlements has already issued early warnings. Autonomous AI decisioning can amplify procyclicality when agentic systems reinforce the same directional movement, tightening together in downturns, loosening together in upturns. They create capital and liquidity swings faster than traditional supervisory cycles can respond. We are entering a prudential era where systemic resilience depends on an institution's ability to model not just economic cycles, but AI driven behavioral cycles. Liquidity is no longer a balance sheet question, it is an algorithmic consequence. Systemic fragility, the real risk vector. Fragility is no longer a balance sheet problem. The real fragility is not on the balance sheet, it is in the architecture. Fragility today lives in feature lineage that is unclear, data dependencies that are unmonitored, API behavior that shifts without human review, autonomous agents optimizing for conflicting objectives, distributional shifts that only appear at scale, capital consumption patterns that react too quickly. In AI era finance, fragility is created upstream inside the decision pipeline long before it appears as credit losses, liquidity stress, or supervisory issues. This is why Quant Human is necessary, not as a strategist, not as an analyst, but as the only archetype capable of detecting these failures at the architectural layer before they surface downstream in economics or regulation. If you cannot map the pipeline, you are building blind. The map of your code is the map of your risk. The global convergence has already started. Across global supervisory bodies, from the EU AI Act to the Monetary Authority of Singapore to the US Federal Reserve, there is a quiet convergence underway. Supervisors are no longer evaluating individual models, individual policies, individual controls. They are evaluating coherence. Does the institution understand how decisions propagate across architecture? Does it track distributional and capital effects in real time? Does it have integrated documentation that reflects the actual system, not the theoretical one? Does it have cross domain reasoning embodied in people, not just frameworks? This is why the quant human matters. Supervisors do not need institutions to be perfect, they need them to be coherent. The new supervisory test is this model fair? It is the system whole? The integrated operating model of the future. Coherence is strategy. The next decade will produce a divide in the financial sector, not between fast and slow institutions, but between coherent and incoherent ones. Coherent institutions will have a unified decision spine, real time propagation monitoring, multi agent governance logic, economic aligned decisioning, system level documentation, and cross domain reasoning built into leadership roles. This is what makes the Quant Human not an optional role, but a structural anchor of the AI first enterprise. They stabilize autonomous workflows. They translate algorithmic decisions into capital and supervisory implications. And they turn governance into acceleration rather than drag. In the machine speed enterprise, coherence is the ultimate strategic accelerator. All of this leads to a simple conclusion. We began with the fundamental truth. AI did not create institutional fragility, it merely exposed the fracture lines that were already there. The future of finance is not about the fastest algorithm, it's about the widest vision. Because in a world run by autonomous code, the only real competitive advantage is systemic coherence. The quant human is the cognitive architecture that restores that coherence. Thank you for joining me.